Welcome to the deep dive. Today we're really peeling back the layers on something quite central to the UK economy. The property and mortgage markets. We've got a stack of sources here looking at everything from, the big shifts in the 80s right up to the pressures people are feeling now. And our mission, for you listening, is simple. To give you a really clear grasp of how this market works, the big economic forces involved, interest rates, inflation, that sort of thing, and frankly, why getting that first mortgage often feels like such an uphill battle. Okay, let's unpack this.
It's definitely a crucial area because, let's face it, for most people, buying a home means getting a mortgage. That's the loan, secured against the property itself. And that security aspect is key. It's what makes mortgage lending generally safer for the lenders.
Right, reduces their risk.
Exactly. But the sources are clear. While owning a home is still this big aspiration in the UK, it's become incredibly difficult, particularly if you're just starting out. And funnily enough, the huge amount of competition we see today, all those different mortgage deals, that actually stems from deregulation back in the 1980s. But to really get why things are the way they are now, we absolutely have to look back at some quite dramatic financial history.
And that history definitely has some, seismic shocks in it. Thinking about the early 2000s, that property boom, loads of cheap credit floating around. But that sort of set the stage, didn't it, for the biggest financial event most of us have lived through. The credit crunch starting in 2007 and then the whole global financial crisis that followed.
It did. And it wasn't just something happening far away on Wall Street. The UK had its own version, driven by very similar underlying problems.
Here's where it gets really interesting.
Well, yeah. The sources point to two main things that massively increased risk in the system back then. First, it was just much easier to get a loan. Lenders were chasing market share, so they started accepting borrowers with, let's say, less than perfect credit histories. These were the subprime or near prime mortgages.
Okay, so riskier borrowers getting loans. What was the second thing?
The second, and this is the really crucial bit, is securitization. It's a bit technical, but basically, lenders didn't hold on to these risky loans. They bundled thousands of them together. Good loans, okay loans, bad loans, all mixed up, and sold these packages off to other investors for cash.
So they got the cash up front, and someone else got the bundle of mortgages and the risk.
Precisely. It took the loans off their books, gave them more money to lend out again, but it essentially scattered that risk far and wide through the global financial system, often in really complicated ways.
So when things went wrong.
When those subprime borrowers started defaulting, the value of those bundles just collapsed. But the real kicker wasn't just the defaults. It was that nobody could figure out exactly who was holding the toxic bundles. Trust just vanished overnight.
Well, we saw that happen dramatically here with Northern Rock, didn't we? The queues outside the branches.
Absolutely. Northern Rock's collapse in 2007 and its eventual nationalization early in 2008 was a direct result of relying too heavily on the securitization model to fund its really aggressive growth.
And once that trust disappeared between banks, the whole system just seized up.
Pretty much. Demand for mortgages just dried up. Banks became terrified to lend to each other, which is essential for the system to work day to day. Those interbank lending rates, they spiked.
Right. Because nobody knew who might suddenly go bust.
Exactly. And that credit freeze hit ordinary businesses too. Suddenly, getting hold of credit for everyday operations became really hard, causing serious cash flow problems.
And all of that tipped the UK into, the technical term is recession, right?
That's right. A recession, just to be clear for everyone, is a significant, widespread downturn in economic activity. Officially, it's defined as 2 consecutive quarters, that's 6 months of negative gross domestic product, or GDP growth. It just shows how a failure in the financial plumbing, like securitization gone wrong, can have devastating real-world consequences.
Okay, so that's the shadow of the credit crunch.
If we connect this to the bigger picture, it highlights that the mortgage market doesn't exist in a vacuum. Its performance is massively influenced by these huge external factors.
Like what specifically?
Things like the general health of the economy, obviously. Simple supply and demand for housing, government policies, definitely. And crucially, those 2 big levers, interest rates and inflation.
Let's dig into interest rates, because that's something that hits people's monthly budgets directly. High rates mean high mortgage payments.
Generally, yes. High interest rates make borrowing expensive. That can stop first-time buyers getting onto the ladder, and it can put downward pressure on house prices because fewer people can afford big loans.
And the opposite, low rates.
Low rates mean borrowing is cheaper. Monthly payments are lower, so people feel they can afford more. That often fuels demand, pushes prices up, and can lead to those property booms we sometimes see.
Now, when we talk about interest rates, people hear different terms. There's the Bank of England rate, but then there are other rates too. Can you clarify that?
Good point. It can be confusing. The main one is the bank rate. That's the rate the Bank of England charges commercial banks to borrow money. It's their key policy tool.
Okay.
But the rate you actually pay on a mortgage is often influenced by or directly linked to the rates banks charge each other for short-term borrowing in the wholesale markets. Since late 2021, the main benchmark rate here is called SONIA, the Sterling Overnight Index Average.
SONIA. Right. So that reflects the real cost of money between banks.
Exactly. It's based on actual overnight lending transactions. So when the Bank of England changes the bank rate, SONIA usually follows pretty closely because the base cost of borrowing for everyone has shifted. Mortgage lenders then price their products based on these underlying costs: the bank rate, SONIA, their funding costs, and perceived risk.
And the Bank of England uses this whole system, this bank rate lever, primarily to control inflation.
That's its main job, yes. Monetary policy, as it's called. The government sets an inflation target usually around 2 to 2.5%, measured by the Consumer Prices Index, the CPI.
So how does raising interest rates actually bring down inflation? It seems counterintuitive sometimes.
Well, think about it. When the Bank of England increases the bank rate, borrowing becomes more expensive across the board. Mortgages cost more, loans cost more.
So people have less money left over after paying their debts.
Precisely. People's disposable income effectively reduces. When people have less money to spend, overall demand for goods and services tends to fall. And when demand falls, businesses usually find it harder to raise prices and sometimes have to lower them. That's the basic mechanism for slowing down inflation.
It sounds quite blunt, almost brutal, slowing the whole economy down just to hit a target.
It can feel that way, certainly. It's the main tool they have, and it generally works, but it definitely causes economic pain, especially for those with large debts. And inflation itself, remember, is the decrease in your money's spending power over time.
And we need to be clear, the sources highlight this difference between general inflation, the CPI basket of goods, and house price inflation, right? They don't always move together.
Not at all. House price inflation often runs much hotter than general inflation, especially during booms. But the connection is still there. When general inflation really takes off, like we saw in 2022 and 2023,
Yeah, that was steep.
the bank has to react, often quite aggressively, by raising interest rates significantly. This makes mortgages much more expensive, directly hitting affordability. It reduces how much people can borrow, which eventually acts as a brake on house prices, even if they're still high in absolute terms.
So bringing us more up to date,
Yeah.
the market did eventually recover after the crash.
Yes, it was a slow climb back, but according to the data, average UK house prices got back to their pre-crash peak around 2014. Then we saw, as you mentioned, that real roller coaster during COVID, a sharp dip initially.
Then that massive surge after the lockdowns ended.
Huge surge. And that was definitely amplified by the government's temporary cut to stamp duty land tax, the SDLT, between July 2020 and June 2021. It poured fuel on the fire, really boosted demand.
Which was maybe good for sellers, but didn't really help the underlying problem for first-time buyers, did it?
Not fundamentally, no. The sources really emphasize the ongoing acute difficulties for first-time buyers, or FTBs. They're still caught in that perfect storm: incredibly high prices relative to wages, the need for much larger deposits than in the past, and those stricter affordability checks that came in post-crisis.
Are there numbers on that?
Yeah, one source mentioned FTB numbers nationally fell by something like 12% up to 2022. And another key point, FTBs today are generally quite a bit older than they used to be when they buy their first place.
Which means they'll be paying off their mortgage for longer, potentially into retirement.
Potentially, yes. And you also have this constant pressure from the London effect, as some call it. Insanely high prices in London and the southeast ripple outwards, pushing up prices in commuter zones and even further afield, like Manchester, as people look for affordability.
So faced with all this, what has the government tried to do? We mentioned the stamp duty cut, but that was temporary.
Well, they've tried to intervene on two main fronts: supporting FTBs directly and trying to make things less attractive for buy-to-let or BTL investors.
How are they supporting FTDs?
The main way is through SDLT relief. First-time buyers generally don't pay stamp duty up to a certain property value, which saves them a chunk of money up front.
Okay. And the buy-to-let side, why target them?
The thinking there, reflected in policy changes, is that BTL investors compete directly with FTBs for the same types of properties, especially smaller homes and flats, and can often outbid them, pushing prices up further.
So discouraging investment to help owner-occupier.
That seems to be the goal. Starting in July 2015, they began phasing out the ability for landlords to deduct all their mortgage interest costs from their rental income before calculating tax. That significantly reduced the profitability for many.
Hmm.
And then on top of that, in April 2016, they introduced a 3% surcharge on stamp duty for anyone buying a second home or a BTL property. And that surcharge is set to increase further, potentially to 5% based on the October 2024 budget plans.
Wow, some quite significant tax changes aimed squarely at landlords.
It's a very clear signal trying to tilt the balance back towards first-time buyers and owner-occupiers.
Now, all these buyers and investors, they need lenders.
Yeah.
Who actually provides the finance these days? It's not just the big high street banks, is it?
No, it's a much more diverse market than it used to be, again, thanks to that 80s deregulation. You still have the traditional building societies, of course. Historically, they were huge, and they're still important. They have a legal requirement to focus heavily on residential mortgages. At least 75% of their lending has to be in that area. And they're member-owned, which is a different structure.
Right, like nationwide.
Exactly. But then you've got the big banks, obviously, and also this wave of challenger banks and specialized lenders, names like Aldermore, Adam Bank, Starling, newer players who've really increased competition.
How do they typically fund themselves?
Often, they rely more on the wholesale markets for funding borrowing money themselves, sometimes using securitization, though under much tighter rules now, rather than just relying on customer deposits. This links back to those interbank rates, like SONIA we talked about. Their funding costs are directly tied to those market rates.
Okay, so building societies, big banks, challenger banks, anyone else. What about those riskier borrowers we mentioned earlier?
Well, the subprime, or maybe near prime is a better term now, and other specialist lenders are still around. They focus on borrowers who might not tick all the boxes for the mainstream lenders. Perhaps someone with a patchy credit history, or someone who's self-employed with fluctuating income.
And they manage that extra risk how? By charging more.
Essentially, yes. It's often described as setting the rate for risk. They charge higher interest rates and fees to compensate for the increased chance of default. This sector definitely shrank massively after the crisis, but it has revived because, well, there's still demand from borrowers who don't fit the standard mold. The lending conditions are much stricter now, though.
And it's not always about buying a house, is it? People borrow against their homes for other reasons, too.
Absolutely. Using home equity for things like debt consolidation or major home improvements is quite common. This is an area where regulators like the Financial Conduct Authority, FCA, are particularly focused on ensuring lenders treat customers fairly, especially if they might be considered vulnerable, for example, consolidating lots of expensive debts into their mortgage. There's a higher duty of care required there.
Okay, so let's try and pull this all together. We've covered a lot of ground in this deep dive. For you listening, hopefully you've now got a much clearer sense of things. You've seen how that complex financial engineering, securitization, when mixed with risky lending, could cause such chaos back in 2007. You also understand, I hope, how the Bank of England uses interest rates manipulating that bank rate, which then feeds through to rates like SONIA to manage inflation, but how that directly squeezes your own finances through higher borrowing costs. And finally, you can see the kind of difficult choices governments make with taxes, like hitting buy-to-let investors, trying to help first-time buyers in a really tough market.
It really is this constant balancing act, isn't it? That tension between keeping borrowing affordable and keeping the market stable. We know that very low rates for a long time tend to push prices up, maybe unsustainably, because borrowing feels cheap.
Right.
But high rates slam the brakes on affordability for new buyers and can cause real hardship for existing homeowners whose deals expire. So here's something to maybe think about. Given what we've discussed about how different lenders fund themselves, what specific impact might a prolonged period of significantly higher interest rates, meaning expensive wholesale funding, have on the actual business models and market share of those challenger banks and specialist lenders?
The ones who rely heavily on those markets compared to, say, the traditional building societies with large deposit bases. Which type of lender is best positioned to thrive or struggle in that kind of environment? It's a dynamic that shakes the choices available to all of us.